for stocks, you think hawkish Fed plus higher rates, bad for the housing market, which is why you sold Lennar. And you didn't even own it for that long. You bought it towards the end of June at 67, and then you just sold it. Can you talk me through that?
Yeah, so I think housing is a really interesting sector. Structurally, we have a housing shortage. And so I think this is like one of the most interesting parts of the market. And so that's why I originally bought it. And I thought it had been overdone. I listened to the earnings call. It had a 4 PE. I think it has a 5 right now. But what's fascinating is the White House press secretary, as well as Biden, the past 3 days have been telling us that this inflation number was going to be really hot. And they kept saying, well, it's going to be old data. And so I knew this number was going to come in high because they already had told us. And so my sense was, well, I've got around a 15% gain on the name. This is definitely a bird in the hand type of market when you can get a 15% return in a few weeks, which I didn't expect that to happen. And so I felt that the Fed would be more aggressive, or the market would think the Fed would be more aggressive after this hot print. And so I just took my profits. But I definitely want to get back in because I do think this structural change, the structural shortage that we have, will be positive for them long term. But now I just need to look and see where it's going to trade. It's really not down very much today, which is somewhat surprising but great. So I think as an investor, be a bird in the hand versus two in the bush right now.
Yeah. So, Joe, you have an interesting move, too. You bought Chipotle again. Why? Why do you keep zeroing in on this one? Of all the stocks in this market, why CMG?
I think there's a very good lesson there for the viewers, and that's in the environment that we're in now, where you have persistent and elevated volatility. You want to stick to investing and trading in companies that you know well. You don't want to really step outside your comfort zone and explore opportunities in a company that you don't know so well. And I know Chipotle very well. I've traded around it for the last couple of years, sometimes really well and sometimes not so good. I've cut my losses when I can. In looking at my portfolio, I am significantly underweight consumer discretionary. Lululemon is all I have. When I look at the opportunity where a market down significantly today presents itself, I wanted to add some exposure to consumer discretionary. Chipotle is going to be the name that I'm going to look at. In terms of fast casual, it is clearly outperforming its peers in terms of its ability to deliver on margins and offsetting the inflationary costs. Understand they raised prices in Q1 10%. Consumers kept coming back. They were raising prices in Q2 12.5%. 42% of sales are now digital. So it's a great company. Brian Niccol is really clearly guiding this company in the right direction. And I just needed to increase the exposure. I'm comfortable with the name, added it to the portfolio. I will add one thing to this conversation. I have too much agriculture exposure. It's not working. I've advocated that over the last several months. If the market gives me a little bit of a lift, whether it's Deere, Archer Daniels Midland, or Bunge, I'm probably going to have to sell one of those names.